The earnings growth expectations have been improving in line with the global economic recovery. We're already seeing economic data coming through showing a much better than expected Q1 growth, not just in the US, but actually across the world. So really that earnings seasons for Q1 should, if anything, really prop up, keep a good base under the equity market and start to justify some of those really extended valuations that we've been looking at.
So when experts like yourself, they look at the numbers, they model things out, they try to forecast what's happening, they pin valuations on these. At what point, Seema, just give us some insight into your thought process. At what point do you start to say to yourself, how much has been priced in? We know that these financials and energy companies have rallied so tremendously over the last 6 months. How much optimism is already baked in there? And we know the expectations keep rising. Are the expectations now at a point where we say, hey, it's buy the rumor and then sell the news?
Dom, that's such a good question. And it really is. It's an important one. It's one that we get asked a lot by investors, especially in recent weeks, as people are starting to wonder, look, is this already priced in? And really, how much further does that rotation have to go? Well, I think from our perspective, we are looking at a global recovery, which is only just starting to unfold. It's still got much, much further to go. We've had some really good news, especially in the US from the fiscal stimulus package. And also with the reopenings that are taking place with some generally good vaccine news. So to our perspective, we think this has got further to run. Valuations, of course, are an important element of any kind of analysis for long-term investing. But just because things are expensive doesn't mean that it doesn't mean that they can't continue to do well, as long as there's a strong global growth outlook. And as long as central banks are still going to be very supportive, which is where we are today. So from our perspective, financials have still got further to run.
The case has been made, Seema, that there are bubbles popping up in certain key parts of the market. And when I say key, I mean the most high-profile ones. Bubbles popping up there. Are those bubbles, say, in cryptocurrency, in certain parts of the tech sector, communication services sector, or even now the energy sector? Are they worrisome at all? Are they indicative? Are they tea leaves for a broader, perhaps, correction that could be in the offing? Do you feel as though these bubbles are things that we should worry about?
Look, I think it's always important to keep an eye on these bubbles. And, with the amount of central bank stimulus that we've experienced, not just in the last year, but actually over the last 10 years, it's understandable that investors are increasingly concerned about bubbles. Now, with the cryptocurrency, potentially, look, that's a really, really volatile part of the market. And an investor who's looking at that side needs to be very aware of the risks that they're entailing. When we look at technology, on the other hand, actually, we have some really good expectations about their earnings. You look at their positive cash flow. It far outweighs anything that we're seeing in the rest of the market. So although there could be some short-term turbulence for technology as some of that stay-at-home trade starts to fade, actually, from a longer-term perspective, tech probably has got further to run. And I think some of the other bubbles, concerns about where central banks have been applying a lot of their liquidity, those things, they will come to fruition one day. But actually, we're not too concerned about it in the short term. Certainly 2021 to us is a pretty good year for markets.
Shepard Smith here. Thanks for watching CNBC on YouTube.